So this is our second class in insurance. It's going to be a short lesson. We haven't got too much theory in this chapter, so I'm covering the second half of the theory, and then our last lesson this week will be going through the calculations. Quickly looking at the last day of focus here, obviously insurance, the definition is financial protection against financial loss, and we had the 5 principles. Insurable interest. You can only insure something that you own. You must benefit from its existence and suffer financially from its loss. Utmost good faith is that you basically tell the truth on both proposal and claim forms. You will not hold back any information and not include anything which is seen as a material fact, such as, depending on for your health conditions, for your health form, you have to state previous health conditions or surgeries or anything like that. You're not going to withhold any information. Indemnity, you cannot make a profit from insurance. Contribution, you cannot basically sign up to many different insurance companies and expect a profit off of an accident by getting them all to pay you. If you insure an item with more than one firm, they'll divide up the cost between them depending on how much you paid for each insurance premium. And finally, subrogation. So for this one, for compensation, if you are to receive any compensation, you waive the right to any further claims. And for example, a car, if you were to write off your car, the car belongs to the insurance company. The money goes to you. You can't hold on to the car and claim something else down the line, or obviously maybe sell the car for parts or something like that. Insurance premium calculations. We're going to get to calculating some premiums soon. A premium is how much you have to pay for the insurance. So obviously if I decide, well, obviously you have to get car insurance, so it's illegal to drive without it. But if I'm to get car insurance, when I started off driving, my car insurance I think was 1,800. Now it's down to 700. There's many different reasons as to why your premium, the amount you have to pay, is going to be very, very high for a young beginner driver versus somebody who's a little bit more experienced. And obviously the more experience you have and a few other factors, the cost of the premium goes down. So premiums are calculated by an actuary. That's their job. So an actuary is somebody that calculates premiums based on a number of factors. We see 5 of them there. So risk, the more likely the risk is to occur, the higher the risk, the higher the premium. So if you drive a car, again, I kind of mentioned this briefly the last day, that if you drive a car and you're literally only driving around the town for maybe an accumulated time of 2 hours a week, you're not very risky in terms of, from an insurance company, they're not going to think that you're a risky customer if you're only driving for a total of 2 hours a week around the town because you live close to your house, or you live close to your work. You live close to your work and you drive to shops or whatever, so you're not a risky customer. The risk obviously goes up exponentially if you then change your job from living across the way from your job to living 2 hours away from your job, and now you could be driving 20 plus hours a week because you're over and back to work 5 days a week, and you're doing a bunch of other traveling too. So your risk has gone up, and if your risk has gone up, your premium has to go up. The cost you pay for insurance has to go up too. Claims, the amount paid out by insurance firms in the past will affect the level of the premium, and that is quite unfortunate, especially for car insurance. Car insurance is so expensive because of basically the amount of losses an insurance company would have if they didn't charge everybody a lot of money. And it's unfortunate, but obviously there are people out there who try to abuse the system, try to almost stage a crash, or if they're involved in a crash, they completely exaggerate their injuries, and you've people claiming whiplash when they're perfectly fine. And because of this, the insurance firms obviously have to pay out a lot of money, and in return for doing that, they need to raise their prices. So sometimes you'll find that you could have, again, in my position, I'm paying €700 at the moment for insurance. I would hope that as I get older and more experience, and obviously hopefully I don't get involved in a crash, I keep my no claims discount, that my insurance will continue to go down, but it mightn't go down. it might go up. If insurance firms are paying out an incredible amount of money because other people are being involved in accidents and claiming, then it can go up. So based on other people's incidents. So value, quite simply, if I buy a Mustang, if I buy a Ferrari, if I buy something that's very expensive, generally maybe acceleration is much higher, the value of the car is much higher, I'm going to pay more. The engine is bigger, all these different things. There's a load of different factors that would go in, but obviously if you're driving a small little, let's say small little Peugeot or anything like that, a 1 litre petrol car, you're not going to pay as much for your insurance compared to if somebody's driving a 4 litre big Hummer truck. So the value of the car and the type of car, or obviously the value of the house or anything like that, is going to increase the or change the value of the premium. Loadings, so these increase the cost of insurance premiums as they add extra risk to the policy. An example of loadings would be if you were getting health insurance and you were a smoker, it's just an additional cost that they would put on to your premium. Also, if you are like a disaster on the road and you're involved in many crashes and you've been had multiple claims put against you for your car insurance, you can expect to pay a very, very, very large sum for your next renewal. So they'll add extra cost. It's loadings, they'll increase the cost because of your history of driving. They will add to your premium because you're a risky customer from past experience. Discounts, the person seeking insurance can reduce the premium by taking steps to reduce the risk. Again, I'm using car insurance because it's illegal for you to drive without it, so everybody has it. So obviously there's more information on it online and it's discussed more. For car insurance, especially for a young driver, there are some insurance companies, I know Aviva do it and a few others, where they have this system set up. I don't know exactly what's involved, but they can have this form of a tracker in your car that basically is able to monitor your speed. It has a GPS system, so the system is the whatever the hardware device is, it can using its GPS, it can see what road you're driving on, see what the speed limit should be on that road, and then compare it to how fast you're actually going. And if you're seen as a safe driver, basically if you stay within a healthy or a safe driving speed, depending on the road you're going on, and if you have built up that history, and obviously this machine would log all that, then you can show the insurance company that you're a safe driver, and obviously they can reward you by giving you a discount on your next premium, even though you might only be a 18-year-old kid just literally on the road. And usually the cost would be quite high, but if you can kind of build up a history with something like that, you can build up a discount. And obviously in reverse, if you have that tracking system in but you're driving around like a maniac, then you can expect to pay quite a bit. Regarding taking down, actually, just one thing, some of these slides I won't get you to take everything down, but I will for that one, because calculating premiums is it can be a common enough question to come up in some shape or form. So I'll get you to take down that slide. Insurance summary. It's a summary, quite basic in terms of the different steps. Important for you to be able to understand and to be able to discuss in a question if they're asking you about a specific stage. So again, I'll get you to take this one down as well. So step one would be to contact an insurance agent or broker once you're signing up for your insurance. So let's just say you turn 17, you get your provisional license, and now you're on the road. You contact Liberty, you contact some local broker in the area who will go through an insurance company for you, and you basically, obviously, well, that's just step one, it's contacting him. Step two is completing the insurance proposal form, and whether they ask you questions online and they fill out the form while you're speaking to them, or you go online to fill it out, or you fill it out at home, sheet of paper on their application form, that the proposal form, that would be obviously step two. You're actually signing up for insurance. Step three is you have your premium calculated by an actuary. They go away and they assess you as a customer and calculate your premium. Again, premium is how much you pay for your insurance. If you weren't aware of that, just write that down. Premium is how much you pay. You know, your compensation is how much you receive. Premium is how much you pay. Step 4, insurance policy is issued to the customer. They'll come back to you with the policy, basically stating, you know, let's say you're beginning your first driver license or your first insurance with your first driver's license. They're coming back to you and saying, you know, that this is a car that you're driving in, this is the cost, this is how long the insurance is valid for, you can only drive in this car, you can't drive in other cars, you know, a couple of other different policy measures that they might add in. So that's the policy. It's basically just information on your insurance and including the cost, the premium. No, so that's all the stages involved in signing up. Step 5 then is obviously if something happens, and if there's some damage, if there's some crash or whatever happens, now you have potential for a claim. So you're filling out the claim form, obviously in the event that something happens. And step 6 would be if you were wronged in any way from the accident, if you had, you know, your car was damaged, somebody drove into the back of your car or something like that, you can receive compensation. And compensation is the money you receive, premium is the money you pay. So there are the steps. Again, I'll get you to take those down. Finally, I'm just finishing on this just to keep it nice and short. I'll just finish on these 3 slides because I did go into a bit of detail on the first one especially. I will just the next couple of slides that we'll be doing for the next lesson you won't be taking down as much information, but I'll get you to take down this again because these are different forms of insurance. I'm not going to call out each one, but the left, obviously the Venn diagram there, the left side is our household insurance. These are different insurance for a household, and what I mean by a household is generally just anyone. It's just a person, basically. You're not a business. So it's just you yourself, not necessarily all to do with the house. So income protection is there. Protection, just in case you're not sure, that income protection would be if you have a fear of potentially, let's say you're an athlete and you have income protection in the event that you were to sustain a long-term injury. You know, the insurance company would pay out some of your salary. So that's what that is. Travel insurance, if you ever booked on flights, you'll be asked incessantly to purchase travel insurance. It helps to pay off any or you'll receive compensation for maybe an accident or medical expenses while abroad. That's just some of the household. Life assurance. Assurance is different to insurance. Insurance is protection against a possible loss. Assurance, life assurance, is protection against a loss that will happen. And there's only one thing that's guaranteed to happen, and it is loss of life, that you will die. Sorry to be so morbid, but that's what life assurance is. So life assurance is basically protection upon death. Generally, what you'll find, well, you know, it's common for you know, a lot of people to take out life assurance, especially as they get older. But you will find a lot of the time that maybe there is a family where there is one person who is the you know, one person who's bringing in most of the family's income, and upon that person passing away, the family would be in a, I suppose, financial crisis on top of everything else. So if you have something like life assurance, it's kind of protection against basically that person passing and you losing your income. So there's an assessment based on how much that person might have earned for family and providing for the family, and they'll pay a certain amount of premium. And if, depending on the life assurance they had, if they die at a certain point, then the insurance company will pay out a large sum to the people listed on the will. So there's some of the household insurance right there. Obviously it's a Venn diagram. The subset in the middle is what's shared between household and business. So property, premises is your house insurance for a household, and obviously for your general property for your business. Contents is what's in the house. Motor insurance obviously is car, and PRSI is what everyone's required to pay We'll go into that more in the next topic. It's pay-related social insurance. Business insurance, quickly, these are just insurances that a business can take out. Product liability, public liability, employer's liability, key personnel, fidelity guarantee, consequential loss, cash in transit, plate glass. Going into more detail on them as time comes, but they're not as commonly assessed. Sometimes you might just be able to, generally you're just asked maybe to kind of list forms of business insurance and list forms of household insurance. Some of the more common ones that we'll look at are the ones in the middle, to do with house insurance, car insurance, and PRSI. That's all for today. 3 slides. I'll get you to take down the 3 of them. And I'm not assigning homework. I'm just going to get you to take down those 3.